Hey everyone, welcome to the Amberdata podcast. I'm your host, Chris Martin, joined today with Colton Conley of Prime Protocol. Really excited to have Colton on today. We have a lot to talk about with Prime Protocol and DeFi in general. Colton, do you mind giving us an introduction to yourself?
Sure. Thanks for having me on, Chris. So I'm Colton. I'm the founder of Prime Protocol. Prime Protocol is a cross-chain, decentralized prime brokerage. The idea is you can deposit on any blockchain we support and then borrow on any other blockchain we support without having to bridge your tokens. Everything is cross-margined. So it's the first fully cross-chain borrowing liquidity protocol.
Yeah, really interesting. We're definitely going to dive into that. But let's go back a little bit. You started your career in TradFi before
Mhm.
finding Prime Protocol. What led you to founding Prime Protocol? Yeah, was there any trigger or any event that kickstarted this?
Well, I had been in crypto just personally for a long time since late 2016. Originally just as a retail investor. Then I started building arbitrage bots to go between these different centralized exchanges. That was back when there was a ton of opportunity to do that. And you could do it as a one-man show. And then I got into TradFi, was still doing a ton of crypto on the side, and got really into DeFi. And it got to the point where I was doing really well at the DeFi stuff. I had a lot of strategies that I was running, and the market was ripping. And I thought there was really a need for what I'm building now with Prime, because coming from a TradFi background, I saw how much more efficient things were on the other side. And I thought there was definitely, if we do believe that financial services are going to continue moving on chain, there's a need for feature parity with what exists in traditional finance. And the main thing I was frustrated about was I was doing a ton of strategies involving different, involving leverage. So whether it's leverage yield farming, hedging to try and get my portfolio closer to delta neutral, leverage strategies to go long certain assets that I was bullish on. But the problem was if I was doing all of that on chain, none of it was connected. It was all separate accounts. So I had different liquidation thresholds I was managing. I had tokens on different chains and bridging them to rebalance the portfolio between different chains. Total pain in the butt. And Prime is basically the solution to that. And so I'd been thinking about doing this for a couple of months, playing with the idea, and then eventually it was the right time to get it started. Part of that was dependency on message passing protocols starting to go live, and so yeah, I think it was sort of right idea, right time when I got started on this.
Yeah, that's really interesting. I definitely feel the pain between switching wallets and bridging between different networks all of the time. It's expensive and it's time consuming.
Yeah.
Um, I don't want to talk too much about regulation, but uh, why now? Why DeFi?
Well, I think DeFi is super important if you want to make finance or financial services more accessible to people all around the world. Right now, that's definitely, if you're not in the US or Europe, there are a lot of different kinds of financial services you just don't have access to. Giving people access to more stable currencies, also a huge public good that I think is really important and also beneficial for the US as well. If more people are holding dollars, that's good for the United States. It's also good for people who live in hyperinflationary regimes. And then I'd say the last thing that's really important about DeFi, especially within the US and these countries that are, cranking up on the regulation, is it's actually way more transparent than traditional finance. It's so much harder to commit fraud or actually do bad activities with DeFi because everything's on the blockchain. So everything's traceable. You can see what's going on, and you can also see what people are doing. Whereas in traditional finance, I think there's a lot of smoke and mirrors. People don't really have the like. I know the SEC loves to say things about like disclosure requirements and all of that, but the beautiful thing about crypto is it's all on chain. And you can go and see the code. You can see like what the rules are, who's doing these transactions. And so I actually think from like longer term, once regulators start to see, and maybe we need younger people in government to realize this, but I actually think crypto makes the exchange of value a lot more safe as well, and transparent. So there's a whole lot of reasons for DeFi. I'd say accessibility, transparency, trust, accountability, all of those are reasons why this is really important technology.
Yeah, I couldn't agree with you more. Having worked in compliance myself, it's fascinating to me how traceable everything is in crypto versus traditional finance. Um, I'm curious your thoughts on online sleuthing. Do you think that this is a wave that's being started? Do you think it's supporting the conversation of like, crypto is open for everyone, data is useful for everyone, or do you think that it's potentially doing more harm than good?
I guess mixed opinions on that, but ultimately, like I think a system where everybody has the same information and same access to information is what we want to go for. That's what makes markets most efficient. It also ultimately, once tools are built around being able to offer this information to the average retail investor, retail user, so they can see what's going on and have the same access as everybody else. I think that levels the playing field for everybody. So in general, as I'd say, like making things more transparent and available to people, I'm a big fan of. Um, and so, like obviously there are drawbacks too. Like nothing's going to be a perfect solution, but in general, if the data is public and on chain, and you're using it to make the market more efficient, I think like in the long run it'll be a net positive.
Yeah, awesome. Let's go back to Prime Protocol. I'm curious, sort of the architecture, how it works. You use Moonbeam quite a lot, right? Is
Yep.
that what's the decision behind Moonbeam? How does this come about?
Sure. So maybe it'll make sense if I explain how the architecture works, and then I can explain like Moonbeam's role in that architecture.
Yeah, that would be awesome. Mhm.
So the high level is Prime is a hub and spoke application. So we have one chain that is running most of the guts of the logic. It's running the liquidity checks. It's keeping track of your balances. And anytime you interact with any of the blockchains in our network, there's a message that goes from the blockchain you interacted with, which we call a satellite chain, and it goes to the hub chain. And then the hub chain makes some decisions and decides whether it's necessary to send a message back to the satellite chain. Maybe that's because it needs to send you tokens there. And so the reason why using Moonbeam as a hub chain made sense for us is we wanted a chain that was very cheap, because every user who's using our application is using the hub chain in the background. So we wanted to make sure that we were passing on as many cost savings to them as we could. So using like ETH L1 would have made no sense, because then the application would have been unusable. It would have been so expensive. And so we needed it to be cheap. We also needed it to have a fast time to finality. A lot of the L2s that have come out recently, like Arbitrum, Optimism, Polygon, those are fantastic networks, and we love all of them. But finality on ETH L1 takes about 15, 16 minutes if you want to be like pretty sure that nothing's going to be reorganized. And then add on top of that, like an optimistic layer where the sequencer is bundling transactions and then publishing them to L1 on some cadence. And so what that means is that if you have like a message that you're sending from Arbitrum to somewhere else, that message is going to take 20, 22 minutes to get there. And that's why if you have ever bridged using another bridge, like from Arbitrum somewhere else, and it wasn't powered by like a market maker, it took at least 20 minutes. And so if we had put our hub chain on one of those, that means that every transaction that you did that would have required like an outgoing message. So like a borrow or a repay, like a borrow or a withdrawal or liquidation, we would have been adding 20 minutes to the transaction time. Whereas with Moonbeam, because it's on Polkadot, and Polkadot has really fast time to finality, right now it's about 12 seconds, and there's an upgrade that's going to push it to 6 seconds. It's really speeding up the transaction and reducing latency. So that was another big thing for us. And then the last one was we wanted to make sure that because there's a lot of complicated logic going on, and as we expand to more chains and networks, the potential gas cost of a transaction gets higher. We wanted to make sure we were on a network that had a really high gas per block limit, and that was able to handle these complex transactions and do a lot of logic and still fit it within the limit per block. So that allows us to expand to more chains without having to like deploy a version 2 on an app chain or move the hub. So those were a few of the different considerations. The last one was we really liked Polkadot's XCMP architecture, and really fits in with our thesis of like a multi-chain future. And so we can take XC assets, and in the future, we'll be able to use XCMP to send messages between different parachains. So we won't even need to go over like an Axelar to send a message from Prime to another Polkadot parachain. It can be really seamlessly integrated. And so that was another appeal of Polkadot. And there wasn't another network that had the same kind of shared security architecture that makes that possible.
Yeah, that explains quite a lot. I think one of the challenges with cross-chain protocols, and maybe this is more prevalent for bridges, but you can open yourself up to more risks and attack vectors. What's your approach to security and maintaining a safe protocol when it comes to exploits?
So I guess there are a few things to address there. The first is, how are you doing your development practices? Making sure that everything that goes in, you have protections just on your GitHub to make sure every line of code is getting reviewed before it gets merged in, and that you're doing everything really methodically, and that you spec things out first. Then you do the development, rigorous testing, have other devs on the team review it before it gets basically put into staging for audit. Then we had everything audited by a key blockchain, and then Veritice, and then we had follow-ups. So we've done multiple audits of the entire code base, and we were really selective too with the auditors that we chose. We didn't just go for like the big shops that just sort of churn out stamps of approval. We like looked at their audit reports that they had done for other protocols. We interviewed a ton of them. We got feedback from the projects that they'd worked with. And then, yeah, I think we did a good job choosing our auditors who did a very thorough job on that. And then the last step is how do you put risk limits in place and protections to make sure that if something did go wrong, you're mitigating the damage that's caused as much as possible. So part of that includes making sure that while we like minimize upgradability as much as possible in the contracts, we still have the ability to like freeze or deprecate markets, and make sure that all of that functionality has been tested. Everybody is like briefed on the SOP, so that we're able to take action if it needs to be taken. And then the other aspect of this is managing your economic risk. So a lot, like some protocols just get hacked because there's a bug in the code, and we've certainly seen that plenty of times with other DeFi protocols. Usually it involves pushing unaudited code or doing something really sloppy that's like a small bug that, or like, yeah, it's usually something that you don't expect, and it's due to sloppy development practices. Economic vulnerabilities are due to basically too much risk taking on the price oracle or asset side of things. And I think you alluded to that earlier, but basically like you can think of a Mango Market style attack where you have some token that really shouldn't be on your platform, that you shouldn't be offering as collateral, where you have a manipulatable price oracle. And then the attacker can come in and try and manipulate the price of something, use that as collateral to then withdraw large amounts of other tokens. And so the way that we mitigate against that is to make sure that all the price feeds that we're using aren't just pulling from like a single TWAP on a DEX, that the tokens have deep liquidity. The price feeds are medians of different sources of data, so it's very hard to manipulate. We use Chainlink, and that's how they do that. And those price feeds are kind of industry gold standard. And we also make sure that to minimize the latency of the prices, all the price feeds are done on Moonbeams, so it happens in real time when the liquidity check is happening. We're not passing prices between different chains. And then the last aspect is, where do you set your LTVs, and how do you basically mitigate protocol risk with your risk limits? And so not only are we relatively conservative on setting our LTVs, we also added risk premiums for the borrowable assets that people take out. So the previous paradigm in DeFi was you basically have collateral, you decide how risky that collateral is, and then you give it a number. So let's say you have ETH, you decide it's like sort of risky, so you'll say, I'll give it 75% LTV. And there's obviously like more thought that goes into that, but that's sort of the abbreviated thought process. And then you say, okay, you can borrow anything against it at a 75% LTV. Well, that doesn't make too much sense to me, because let's say you have like dollars and you wanted to like USDC and you wanted to borrow USDT. The chance that USDT is going to go up in value, pretty low, like above $1. Like maybe it's going to go a few cents higher than $1, but it's not going to $10. And so the riskiness of borrowing USDT against USDC is a lot lower than the riskiness of borrowing ETH against USDC, because ETH could go up rapidly, your liabilities increase, and that puts you closer to liquidation. And so what we've done is we also have loan premiums, where we take the likelihood of an asset increasing in value. There are also some other considerations involving latency that apply to this. But basically, if you have a more risky asset, then you can borrow less of it, which protects us in a lot of those scenarios. That also allows us to offer slightly more competitive LTVs if you're just borrowing stablecoin versus stablecoin. And then the last thing, I know this is probably a longer answer than you were expecting, but the last thing we do is for assets that we think are more risky, we can limit the amount of the collateral base of the protocol that asset can comprise before people are no longer allowed to borrow against it. And so a lot of protocols do borrowing caps. And so we have something sort of similar that's going on in the background, where we have basically these dynamic thresholds that we can set to make sure that you're not the protocol isn't too reliant on some of the less liquid assets, like Polkadot token. So that basically allows us to make sure that if somebody did try and perform a Mango Market style attack, it wouldn't even be possible, because they would just be blocked from borrowing against that asset.
Yeah, that's a lot to unpack there. It's a great answer, though.
Yeah.
I'm curious how you come up with your asset risk evaluation. What sort of data do you pull in to determine, will the price increase? What's the riskiness of this asset for collateral or for borrowing? How does that happen?
Yeah. So our starting point is basically based off of the gauntlet recommendations on protocols on the chain where that asset is. And then usually we'll make an adjustment in the more conservative direction if that chain involves more latency in our protocol, or if we have other reason to believe that we want to limit risk on this asset. So an asset that we have been limiting risk significantly on has been USDT. And even though I think it's probably solid, there's a small chance that it could drop fast in value. So we're just being very conservative there. And then we basically have, we also look at max drawdown of a lot of these assets, and then apply a little extra buffer as well, and make sure that the amount of time it would take to perform the liquidation, if looking back in history, a user wouldn't have lost money, or the protocol wouldn't have lost money trying to perform those liquidations. And you have to make sure that the liquidator is always profitable in those situations. Obviously, if you have a super tiny amount that's being liquidated, then it might be unprofitable due to gas costs, but that's the case with any protocol.
Curious why other dexes or DeFi protocols aren't using these risk evaluations to do something similar.
I mean, a lot of them use like gauntlet recommendations, which are pretty standard, and those people are like top tier in terms of their evaluations of things. I think the main difference between us is the protection against the mango market style attack, by having that dynamic risk limit to make sure that you can set don't be more than X% of the protocol for this token. And yeah, I'm really not sure why people haven't thought of doing the borrow premium that we do. Like it makes it much more efficient for the lower risk tokens, and protects you against risk for the higher risk tokens. There's probably a step farther that we could do. It's just very hard to calculate like correlations and things like that on chain. So we haven't, like, it's still pretty rudimentary. If I had infinite compute power, the system would probably be a bit more complex. And maybe that's something we'll deploy in a future version.
Yeah, time to load up those AWS clusters.
Yeah.
Yeah, I think it's really great how thoughtful you guys have been in terms of security. I think, like you said, there's the economic attack as well as the standard bug in code, which is the big nomad hack.
Yeah.
Euler, it was also a very similar attack. So it's great that you're being mindful and choosing the correct auditors rather than any auditor. I think that's a big pit hole that a lot of startups fall for.
Yeah, we didn't choose the cheapest options. We chose the ones we thought were best.
When it comes to liquidity, how does this work? So with most DeFi protocols, DeFi lending protocols specifically, an individual can deposit funds into a pool, use those funds as collateral against other borrows. When you do cross-chain liquidity, you have to have liquidity on both chains. Is that right?
Yes, that's correct.
Yeah. So how does this work if a lot of individuals are putting their collateral on, let's say, Ethereum and borrowing on, let's say, Optimism or Polkadot?
Yeah, so in that case, it depends on what you're borrowing, but if there's a lot of borrowing demand on one chain, the rates go up there, and then that'll incentivize new depositors on that chain. In the future, once like CCTP is fully rolled out, we'll be able to have like global liquidity pools of like USDC. So it doesn't matter where you deposited or borrowed, we can send it to whichever chain it needs to be sent to. The challenge is you can't do that with every asset because there's not a canonical bridge for most assets. And it's the more like we do have some wrapped assets like wrapped Bitcoin because we wanted to be able to offer that as collateral. But you really want to try and minimize the number of these bridges that you're relying on. I'm glad we chose not to support any swap assets because obviously there's been risk there. I think it's just hard. And a lot of assets also don't make sense to be bridging from one chain to another, so it'll make sense to have depositors on different chains supplying the liquidity. But you can think about it like you're going to need liquidity supplied to each different asset on a single chain as well. Like this is the same issue that a lending protocol would run into if everybody wants to deposit ETH and borrow USDC. Like the USDC has to come from somewhere, and the difference here is that USDC pool just might be on a different chain. But that's why interest rates go up as utilization increases.
Yeah, that's really interesting. Does there present an opportunity for lenders to do recursive borrowing, recursive lending? Having collateral in one chain, borrowing it from another chain, bridging it back to another chain where there are higher incentives for lending.
Yes, that's definitely going to be something I think people will do, especially because we're going to be launching some liquidity incentives pretty soon. And so yeah, that'll definitely be a possibility.
Yeah, amazing. I love to see some incentives. On that note, how do you engage with the community? Is there an aspect of community governance in the future?
Yeah. So, I mean, community governance is usually done once you have a token, because that's how you give people voting power. And whether you're doing snapshots or on-chain governance, that's typically how it's facilitated. Since we don't have a token right now, we don't have community governance yet. And I think in the early stages of a protocol, it makes sense to be just trying to build the product out as quickly as you can, being able to iterate and have some flexibility to sort of drive it in the direction that people want it to go. And we certainly are, we love community feedback. We've run surveys of people who are using the application to see what they like and what they don't like. We listen to everything we hear on Twitter and Discord. In the future, once we do launch a token, or if we do launch a token, then we'll be able to decentralize the governance. And my ultimate hope would be that it's completely decentralized and can run just based off of community involvement. And so that's definitely where I'd like to take it and where I'd like to see it go. But there's a path to it, and it doesn't happen overnight, but that's definitely the end state that I see it ending up in.
Yeah, and it seems like you've thought through some of the trade-offs between starting fully decentralized, I should say, versus starting where you have clear ownership
Yeah.
and building that path. Cool. Let's talk about some of the wider trends going on in the ecosystem. Are there any trends that you're seeing unfold right now in terms of protocols, tokens, chains?
I'm definitely seeing a lot of trends towards the different L2s, and those ecosystems have gotten a lot of traction recently. I think EVM has been pretty dominant, and so I'm glad that that's been what we're focusing on, at least for the time being. And I do think there's going to be there's some consolidation happening right now, and I think that will happen in any bear market where there are a lot of experimental ecosystems that maybe struggle to make it through. But I think one thing that I would anticipate will start happening is there are some new chains that are going to be launched in the next year. And I think it'll be interesting to see the ecosystem continue to expand there. Obviously, there's a lot of hype around the ZK narrative. And I think there is still hype around the cross-chain narrative, and people are starting to see the utility in it.
Are there any chains specifically that you're looking forward to?
Looking forward to launching on, or looking forward to launching?
To launching in the future, or any
Uh,
narrative?
I'm really excited about Barachain. I don't know if you've heard about that one, but we'll be looking to expand there once they launch. I'm really excited to see how much traction a lot of the ZK EVMs get. In particular, I'm looking forward to, right now a lot of them are quite centralized. As they're able to decentralize, I think that'll be pretty awesome. So Polygon has launched their ZK EVM, there's ZK Sync, and there's a whole bunch of other ones. And then the last one is Base. I think that'll be really great for adoption, just because of Coinbase's brand and how trusted they are, and I think it's going to be a huge net positive for also bringing on new users who maybe were hesitant to participate on chain before, but might be willing to participate in that ecosystem.
Yeah, I think there's really two key narratives here when it comes to those two networks that you mentioned, Barachain and Base. I'm a big Barachain fan, but it's truly a degen chain, right?
Yeah.
This is not going to help onboard the masses, I think.
Yeah.
Whereas Base is more of a public chain. It's the goal is for decentralization, and it's to help onboard new users.
Yep. And I think you need both. You need to onboard new users, and then you need to show them why it's so much fun to be here.
Yeah, it's
So
the culture of Barachain is
yeah,
fantastic.
yeah.
So when you were building arbitrage bots, I'm curious, how did you find these opportunities? How did you source it? Were there certain metrics that you would look for, or what were you using? Intuition?
Well, basically the way it worked is a lot of chains were still, or not a lot of chains, a lot of exchanges only had REST APIs at the time, like including Kraken and really big ones. Other exchanges had like WebSockets. And so you would basically have these opportunities come up where you'd hit the REST API and the order book that it would return you would be over, like literally overlapping with an order book on another exchange. And I think a lot of these like REST API only exchanges, a lot of the like bigger players who were doing this were only just plugged into the WebSocket, or there's like another one called like a fix or like FIX feed that like Coinbase Pro, which was called GDAX back then, had. And so you basically had this opportunity where people weren't really going after the REST API based exchanges because it's more tedious and smaller opportunity. But you would sometimes just get lucky hitting the server that you'd have like a buy order somewhere that was higher than like a sell order somewhere else. And so you would just then send out orders to both exchanges, hit that at the same time, and then you'd keep like some funds on each exchange so that you'd have liquidity to do that, and then just rinse and repeat. And so it was all automated. There wasn't any like intuition or guessing because you were literally just hitting like different prices on different exchanges simultaneously to open up the to just make instant money, which is pretty awesome. Sometimes people would get in front of you and you have like an order hanging, which sucked, but actually like I would just leave them hanging there and they always resolved. So I never actually got stuck hanging permanently.
Yeah,
So
that's awesome. There's a lot of fear about about MEV takeovers.
yeah, obviously like totally different story in centralized exchange because it just meant somebody had like a faster connection than you did or faster computer. But yeah, I think MEV is a little bit scarier on chain because then you end up paying like a lot of gas and it didn't work out for you. And it's like final. Whereas with the exchange arbitrage that I was doing, like you just have a limit order that's sitting on the book that just hasn't been filled. And so that's like not as bad of a scenario.
Mm-hmm. Yeah, that seems like a pretty safe one.
Yeah.
Do you think these opportunities are harder to find now, or?
Oh, absolutely. I mean, the bot that I was using like doesn't work anymore. It's the everybody is scouring for these kinds of things. And there are very sophisticated people who are doing this for much smaller spread at very large scale.
Yeah. Have you tried doing DEX to SEX cross chain arbitrage? Is that a thing? Did I make that up?
I'm sure it's a thing. I haven't personally done it. I'm just like my portfolio is fully on chain now. So uh, I I use the centralized exchanges as an on-off ramp, and that's about it.
Mm-hmm. Yeah. Is that the path that you see happening in the future? Is that going to be the dominant way you think that crypto evolves?
Yeah, so I think it's interesting. I think probably my thesis on this is you'll still see centralized exchanges as an on-off ramp because you have to be able to connect your bank account somehow. There are a lot of services that are popping up that allow you to on-off ramp directly to your wallet and to connect with your bank account for you. The problem is a lot of those are because it's like you're not KYC'd with them or because they're trying to you know, I don't know, turn a profit, they're charging really big fees. And so I think that's a really big deterrent for people when like I can onboard my money through Coinbase or Kraken and I'm not paying anything to do that. Like the ACH transfer is free. So I think until those on-off ramps can figure out a way to make money without charging some obscene fee, people will still be onboarding through centralized exchanges. I think a lot of the trading on centralized exchanges probably will still be there. I don't think that'll fully go away because you can do like depending on the chain you're using or like the pair you want. Sometimes it's easier to do on a centralized exchange if you're a large fund Um, I think in the future that'll move more and more towards on-chain as like we get better at concentrated liquidity and on-chain order books. Then it'll be efficient enough that we can move it on-chain. My guess is a lot of these exchanges will also start doing integrations with decentralized applications directly into their UI. So if they want you to keep your money within like their ecosystem, what they can do is they can build an integration with, say, Prime, and they say, okay, now that you have your Bitcoin, here's a place you can deposit it and earn 5% a year or whatever it's yielding. And you don't have to deal with the whole MetaMask, Coinbase wallet, or like self-custody thing. You just let the exchange handle it for you. And while obviously, like, I think that's disappointing that not everybody will be managing their own keys, I don't think everybody, I don't think it's reasonable to expect everybody to be dealing with DeFi UX the way it currently is. If we really want mass adoption, I think having the blockchain running in the backgrounds to power the rails for all of this stuff is great. But for the average user who like doesn't really care, I think having them just go through the Coinbase UI and depositing directly into a money market or supplying liquidity directly through to a DEX through the Coinbase UI will make more sense. And I'm sure there are going to be competitors that pop up that do similar things. You've already seen there's like Xerion and Argent and other applications that like this is the idea behind those is they want to make it super user friendly. You don't have to be like signing transactions in your MetaMask and like bouncing between different websites and dApps. You do it all from one place.
Yeah, there's a lot of parallels here to traditional finance as well, right? You have,
Yep.
something like Fidelity or your discount brokers,
Yeah.
where you can manage your own investments versus using a financial advisor.
Yeah. Yeah. So I think, and then there's also Robinhood became very popular because they just provided a better UI to do the same thing that you could do with Fidelity. And then they also, started doing the trading fees differently. And so I think you'll probably see things happen similarly with DeFi where if you can execute more cheaply or you can get better yield through DeFi than you can through centralized finance, then CeFi will have to just start providing a UI for DeFi in the background.
Do you think we're going to see a race to zero like we did in TradFi with trading fees going as low as possible?
Maybe. The reason why I hesitate, a few reasons. First, for DeFi, if you send the trading fees to zero, nobody's going to provide liquidity in the long run. And so those protocols won't get enough traction. And because you won't have the depth in those pools, people aren't going to use them. So it's sort of a balance. And then on like the centralized exchange side of things, maybe you might see fees go down in a race to zero. I think that could happen on the centralized side. They still have to turn a profit, but if they have other businesses that they're able to funnel their users into that generate revenue, and then the free trading is something that gets them in the door, then maybe we could see something like that.
So what's next for Prime Protocol? Are you guys looking to launch on as many networks as possible, L2s, or is there a different direction that you guys have in mind?
Yeah, we have plans to launch on another L2 pretty soon. Plans to release more assets. I'm excited for those liquidity incentives I mentioned, which are coming from a grant that we received from Moonbeam. And then I'm also really excited for expanding the asset selection. So on existing chains, there are a lot of, I think, interest-bearing tokens like staked ETH and those kinds of things that people will find really interesting to use as collateral for a bunch of different strategies. So yeah, we're only getting started. I think what we've got on mainnet right now has been a great proof that the code works and everything's running smoothly. And now it's just time to go into those areas where we think will really catalyze growth.
Yeah, awesome. Looking forward to seeing that, especially the incentives. Last question for you. Is there, or rather, what's the one thing that the crypto community isn't talking enough about?
Probably talking about like how do we make these protocols sustainable in the long run? I know people are starting to pay attention to this, but I think a lot of if we're probably going to go into another bull market, hopefully very soon. And definitely once rates start coming down, I think that will really catalyze another run. I think people really need to be talking about how do we avoid having the same thing that happened last time happen to us again. And I think there is a big problem of like there's too much money being thrown at like for lack of a better word, scammy projects that we're basically running unsustainable tokenomics. And then a lot of people get burned at the end by that. And I think that gives the industry a bad look when really like that's not what this like the value of this technology actually brings to the world. And so I think a focus on more sustainable like business models within DeFi and a focus more on like projects that are offering real value and innovation, both on the technical side and on like the monetization side, I think is something that people really need to be talking about rather than like all of this chatter about the meme coins. Like I'd love to see the meme coins ripping, but I really hope that people aren't aping their whole net worth into them, because I don't think long term that's going to be a good outcome for like crypto in general. You might be able to make a lot of money on it and do well, but I think we need to really start shifting the conversation towards how do we build something long lasting and sustainable, and try and build back a solid reputation as an industry.
Yeah, would love to see that. Great answer. Well, Colton, thanks so much for joining me today. This is a great conversation. I think we covered quite a lot, especially interesting to see the future of Prime Protocol and exactly how you guys got started and what you guys are working on. Really looking forward to those incentives and trying out the platform. Again, thank you so much for joining.
Yeah, thank you for having me. This was a lot of fun.